Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And on today's episode, we are going to be talking about something that is extremely common, building an emergency fund. But what is not so commonly asked is how much is enough. Now, you may think it's a very easy answer, but I can tell you money, especially cash, and especially an emergency fund, it actually is going to evolve over time as one's net worth accumulates. Now, before we get into today's episode, we have to give the shout out. If you have any interest in our books, our courses, previous podcasts, head on over to capitalizepodcast.com. That is our central hub where you can get all of our content for free, or if you want to buy the book or the course, you got to pay up a little for it. Now, without further ado, let's get into this because I'm actually really excited to talk about an emergency fund. So, first off, what is an emergency fund? That's probably the best place to start. An emergency fund is just that. It is money set aside for an emergency. Pretty cut and dry. Now, one thing that I see a lot of people screw up with emergency funds, it's not actually building the emergency fund and having enough. It's building it and then falling to the temptation of touching it when you're not supposed to. So I've actually worked with clients on this where they build up their emergency fund and maybe a year or two goes by and they go, oh my gosh, like this money is just sitting here like, oh, like it's such a tease. I want to use this for whatever. No, that is not the design for it. And then I meet with them between quarter one and quarter two and sure to find out they tapped into that emergency fund, but there wasn't an actual emergency. I've actually seen people, they tap into their emergency fund when they should have, then an emergency comes around, and then you're screwed. And so an emergency fund is just for that. You set it aside. Once you get to that dollar amount, it is basically under the digital mattress. Speaking of the digital mattress, the second part that I want to talk about is where do you house your emergency fund? Meaning, where do you have it? So up until recently, and by recently, I would say probably the past decade or so, it was pretty cut and dry with the checking and savings account. You would go to your bank that, frankly, your parents or grandparents went to. You'd open up those accounts, and there you go. There's not really anything to think about. A couple years ago, and I believe this was 2016 or 17, I started seeing online this whole online savings account craze. And I'm always skeptical when I see things just popping up from everywhere. But even though I'm skeptical, I still want to do diligence on it. And then once I do diligence on it, I can then go back and go, okay, was my skepticism worthwhile, or was there something to it that maybe I didn't see? So when I was researching online savings accounts, one of the things that turned a lot of people off was the fact that there wasn't a physical bank to go into. Now, I'm not going to give specific online banks a shout out here just due to compliance. Then also we're not sponsored by anyone yet in that regard. And really for me, what I heard a lot of people say is because I can't go in, what happens if something unforeseen or unfortunate happens with my money? I get locked out of my account, whatever the case may be. And I thought, okay, well, this is 2016, 2017 at the time. I'm pretty sure technology has come a long way where these banks have figured it out. So I wasn't really concerned about that. The one thing I was intrigued about was at the time, all things being equal, you go to a everyday bank, you're earning like 0.5% on your savings for most people. A lot of these online savings accounts at that time were earning like 3 or 4%. And that's what struck me as odd. So I did some more investigative work. So what do these online banks have that these old, or we'd call retail banks, have today? They have significantly less in the cost department. If you don't have physical banks, you don't have to pay any real estate costs. You don't have to pay the exorbitant amount of employee costs, because if you've got a big building, you better house it, or else it doesn't really make sense to have it in the first place. And so a lot of these online banks, because they don't have those costs, they can save a whole heck of a lot more. And then with interest rates, not getting into the weeds of it, they can basically float a lot of that rate of return to you, the consumer. And so you fast forward to today, I'd say 99 times out of 100, if you don't know where to house your emergency fund, I would probably look at a qualified online bank. Now, as far as your emergency fund, we get questions about this all the time. This is just a quick little tangent. Our CDs or bonds or money market funds, is that a good alternative for a savings account? And I'm really splitting hairs here, but I would say the answer is no. With bonds, there is interest rate risk. So if you buy even government bonds, which are they guaranteed? Technically, no, but they are supposed to be, because the government is backing them. And so I guess if the government went out of business, we're all screwed. CDs and money markets are FDIC insured, but the bummer with a lot of these funds are you are investing your money in these vehicles. So whether there's interest rate risks or CDs, there's illiquidity risk, meaning you can't get the money until the time period comes up. Even with a money market mutual fund, it's still an investment. So, don't try to get cute and creative with an emergency fund. Make it a savings account. Again, if you can, make it an online savings account, but treat it as that and nothing else. So one thing I want to go over is how much you need in an emergency fund, because that's the most common question. And for most people just starting out, the range that I'm going to give you, it's going to be with you for a long time. In fact, my brother and I were talking about this right before we started recording. However, and this is going to be after we come back from commercial break, your emergency fund will ebb and flow like a standard deviation curve, which we'll talk about later. And so just because I give you the initial emergency fund amount, that does not mean that over time you have to just be stuck in that lane. Make sure that you evolve with your money. And that's actually not just with your emergency fund, that's with all of your money. So going back to simplistically, whether it's in my book, within the Certified Financial Planning Board's general rules, within our masterclass, we always like to tell you, if you don't know how much to have in your savings, the recommended range is 3 to 6 months of expenses. So to make it easy for you just with numbers, let's say you're spending $4,000 a month, and if that's the case, you want to have that cash floating in your checking account. Again, money in, money out, but that's always kind of floating around. Once you have that, 3 to 6 months of that, so what, $12,000 to $24,000 off to the side in your savings, and once you have that, you set it aside, and then by definition, you don't need any more emergency fund. It's actually it's not a benefit. It is a behoovement if you continue to build that money. And in my book, we call those people the cat ladies of cash, right? You don't want to be that. Now, as far as getting really specific on where you fit within that range, I'm going to give you some guidelines. Let's say that you're young, single, really healthy, in a really low risk job physically, like financial planning. I could, let's knock on wood. I could technically be paralyzed from the neck down and still do my job. Okay. But chances are I'm not going to be out for an extended period of time. So if you had all of those qualities and again, you're not married, you don't have any kids or people depending on you, you could probably get away with having only 3 months. Now, let's go to the other end of the spectrum. Let's say that you're in, your 30s, 40s, or even 50s, and let's say that you are married and you have a couple kids and your spouse stays home and you're the only one, financially speaking, bringing in money. And if you were out, and I'm thinking of like construction workers as an example, if you slip a disc on the job, yes, you could go and have your disability insurance pay you. We've talked about that in previous episodes. But you could be out for a long time. And unlike with what, an advisor does or a planner does, construction work, if your body isn't working, you're not getting paid. So that's where I would say you'd want to look towards the 6-month side of things. Now, to you business owners out there, even though it's not an individual situation like a W-2 where it's pretty straightforward, you run a business, this same principle applies. Let's use a construction business. You're probably going to need more than 6 months. And for construction workers and architects that are listening in, you know exactly what I'm talking about, because a lot of you don't get paid until a lot of cases like toward the end or after the project is completed, but you've got to pay for all of these goods and services. So it may be more appropriate for you to have 9 months or even up to a year's worth of emergency fund. You look at some of the Fortune 500 companies, some of them have years of emergency fund in place. Now, on the flip side, let's say you run an extremely profitable business and you are making just way above and beyond whatever your monthly expenses are. You may not even need 3 months. You may need 2 months. Heck, you may only want 1 month aside, and then anything else you're taking distributions or doing whatever you want to do with that. If you do run a business and you're running into those questions, you can hit me up, chris@capitalizeyourfinances.com. I'd be more than happy to answer those questions. But for the purpose of the 50,000 foot of the range, 3 to 6 months if you are, just everyday employee, grinding it out. If you run a business, you've got to know your business. But I could say 3 to 6 months is going to be pretty optimal for, I'd say, 80 to 85% of you listening in. Now, after the commercial break, what I'm going to do is I'm going to take the emergency fund up a notch. And what we're going to do is as one's net worth grows, and really as the endowments and pensions and the most successful people in the world manage their money, I'm going to take you to that tip top. I'm not saying you have to do exactly what they're doing, but if you can learn what some of the best, most successful money minds in the world are doing with their emergency fund, I think it's going to help you. So I'm going to get a quick sip of water, come back after the commercial break, and we're going to get right back into it.
Capitalizers, this episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you're at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, at the pinnacle of your career, winding down into retirement, or thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have Christopher A. Panayiotou, the Cap in Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
Welcome back to the show. Now, before the commercial break, I would say relative to what we're about to get into, it's pretty cut and dry. We were starting to rev the engine a little bit on the complexity side of things right before the commercial came to play. Now we're going to take it up a notch because emergency funds are not a set and forget it, 3 to 6 months. Once you're done, you just ride off into the sunset. So let's say that you have that. And as time goes on, because again, once you have your money 3 to 6 months set aside, Let's assume that you don't have any short-term needs like putting a down payment on a car or a home or a piece of furniture, something major. So you're investing that for the long haul. Let's say that you're investing that for the long haul within your 401k, maybe an IRA or a Roth IRA. And then let's also say after that, you're investing outside of your retirement accounts in taxable accounts. And those companies that you own or real estate or private credit, all the long-term investments we've talked about on previous episodes, especially the endowment model, you're going to want to go back and listen to that one if you haven't already. But my point is over time, your money is working for you and it's making you money. So let's say that you need $5,000 a month to live off of, okay? Let's just make it really simple. Well, if you were making $5,000 a month from your investment portfolio, do you think that 3 to 6 month range is still appropriate for you on an emergency fund standpoint? I would say so. I would say that's appropriate. What if you were making $6,000 a month? Still say it's appropriate. Now let's fast forward a little bit, and let's say you're getting up to $10,000 a month. So you're actually making twice as much as what you're actually needing to spend. So this is where it starts to get interesting, because those of you that are listening in, you are not just starting out on the education side of things on finance. We're revving this up a little bit. So what's going to happen is if you're making 10 grand, but you only need to spend 5, what are you doing with that remaining? You're going to want to invest that prudently for the long haul, because if you don't need it for today, statistically speaking, it makes the most sense to go and invest that for the long haul. But as things start to compound, you start to realize, wait a second, what if I did have a rough month on the expense side of things? Well, you've kind of already got a built-in month from what you're making from the 10 grand. So you may only need 2 months worth. Okay. I'm not saying this is a specific recommendation. I'm just getting you to think about it. And then let's say you fast forward to $20,000 a month. Okay. And I know like we're talking big numbers here, but my point is if you're making 20 grand, but your expenses are still 5. And no, the answer is not just to live higher on the hog. Okay. My whole point is you basically are making $15,000 or 3 months worth of expenses after your daily needs are met. So does the 3 to 6 month rule really apply? I could kind of go both ways on that. You know, I could see if you are super conservative on the cash side of things, maybe you've had, and this is when behavioral finance comes into play. Let's say you've just had bad money experiences and you're just extremely cautious about it. Well, then who am I to judge? 3 to 6 months is probably going to be appropriate for you. But if you understand the principles of it and you don't have those preconceived biases that may be holding you back, which is that's not a bad thing. It just is. If you don't have those, I could argue you may not really even need an emergency fund. Okay? So my whole thing is I'm not advocating for not having an emergency fund. I just want to get you all to think about it, because the more you think critically about this stuff, the better you will be with your money. Now, before we wrap up this short episode, I actually want to fast forward to the big leagues, because there are going to be a number of you listening into this that are going to get there. Now, I'm not saying you've got to be a billionaire, but let's say that you go from making, $5,000 to $6,000, $20,000. Let's say that you become a multimillionaire, and it comes a point where it's like, well, man, I mean, how do I manage my emergency fund at that point? Let's say that you work in this industry, and let's say that you decide that you start consulting for endowments or pensions or family offices like the Jeff Bezos or the Mark Zuckerberg families of the world, where they've got billions of dollars at stake. Well, how do you manage that emergency fund? So I'm going to give you the inside scoop because I know exactly how they manage it. And it's actually not as complex as you think, but it is kind of a mind teaser. So, and I'm going to make 3 arguments for you. First one, you can still keep the 3 to 6 months. I mean, it's kind of funny if you've got billions of dollars, like 3 to 6 months, like you're going to be good. But I don't argue it. I'm not going to argue against it. You could basically keep 0 in emergency fund because you're making so much money at that point where you don't really need anything. And then the third one is what I would say is more of an institutional view of money, which sounds really elitist, but it's not. It's just when you're dealing with millions or billions of dollars, it just is different. So a lot of these uberly successful people, what they do, they still have whatever they need in their checking account. They still might have some savings, but what they do with their cash is they say, okay, I'm going to make this number up, 10% of my overall net worth to be in cash at all times to the best of our abilities. And what they do is they actually write out something known as an investment policy statement. I actually do that for myself and my wife and a couple clients that we have, not a ton, but a few of them, just as a fun little value add. They've wanted me to construct an investment policy statement for them. And what it does is it keeps your mind in check and it keeps your portfolio in check on how much you need to have with different types of monies. So let's say that 10% of your portfolio is in cash. Now, what could that mean? That could mean checking, savings, and then anything above and beyond that, they may be laddering CDs or laddering bonds or buying money market mutual funds. And then anything above that, they might say, hey, we want 40% of our portfolio in the stock market and another 40% in real estate and the remainder in private equity and private credit. I'm making all of this up. But as you progress throughout your financial life, you go from not having any savings to an appropriate amount of emergency fund. As you're making money, you realize I might not need as much emergency fund as much as I did earlier. So your emergency fund dwindles because you're making so much. And then what happens is you start to come back and then you start to manage like the most successful money minds in the world. So that really does it when it comes to building an appropriate emergency fund. You now know how much is enough. Not only do you know how much is enough, you know how much is enough for the rest of your financial life, regardless of where you're at on the success spectrum. So if you have any questions about today's episode, if you're listening in, you'd like to be a guest on our show, or if you have questions about your personal situation that you want me to answer on the show, or you just want me to answer it behind closed doors, head on over to capitalizepodcast.com. Hit me and my team up with an inquiry. We look at it every single day, and we try to get back to you as best as we can within 48 hours. But as I've said before, we are getting pretty busy, so I can't make any promises, but I always want to over-deliver. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher Paniotu, Certified Financial Planning Professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. It is important to keep in mind that investments in fixed income products are subject to liquidity risk, interest rate risk, financial risk, inflation risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. Money market mutual funds, though traditionally lacking federal insurance and not without risk, are highly regulated under federal law. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. 401k plan information used is obtained from sources believed to be reliable as of the current date, but no representation is made as to its accuracy and completeness. Benefits may be subject to change at your employer's, the governing pensions, or benefit organization's discretion. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Christopher A. Paniotu is a registered representative with and securities offered through LPL Financial, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.